Good evening to all of you.
Good evening, sir.
Good evening, sir.
Welcome to our class today. And if I remember, the last time we met, we were discussing on how to appraise investment, okay? It was simply on appraisal of investment, okay? And the method we were discussing was on the use of the NPV method, the use of the net present value method. Don't forget, this question will be there in the exam, okay? So most likely, okay, I'm not saying that it will be there, okay, 100% guaranteed, but most times there will be a question regarding how to appraise the project, okay, through the use of the net present value method, okay? So it's worth enough that you do get the concepts in and out, okay? And I think last I met, we discussed a lot of questions, okay? If I remember, we discussed a number of questions, okay? And this was the last question, okay, that we were discussing. Okay, so 1 question, 2, 3. Okay, almost 3 questions, okay, 3 critical questions. So I want to attempt maybe the last one, then we discuss on the next appraisal method, the use of the internal rate of return, okay. So let me check for a question, which we can use to conclude on the NPV method, the net present value method. So I'm going through the question back, okay, trying to look for a question, which, if you check on page, on May 2019 sitting, the May 2019, okay, question 4B, May 2019, question 4B. I'll give you 10 seconds to go to the question. May 2019, question 4B. You there? May 2019, question 4B. Okay, I don't know whether you've discussed it. We haven't. Have we?
No, we haven't.
Okay, so the question is more similar with what we have been discussing. There's no any difference. So you can see that this machine, okay, this is a question, is a replacement question, okay? So we are replacing the current machine with an existing machine. Okay, I think, okay, we can do it together. So take 2 minutes to go through it, then we discuss together. But there will be no difference between what we've been discussing and what the examiner was expecting of the students in this particular sitting, okay? And it takes 2 minutes to go through it, then we discuss together. Okay, I presuppose that you have gone through the question. and you understood what the examiner was asking. Okay, so in this case, just like we were doing in the previous examples, we want to make an assessment as to whether it is worthwhile for this company to invest in a new machine, okay, to replace the old machine with a new one, okay. So you'll be told that the following will be the profit before depreciation tax over the 10 years for the two machines is given as follows. So the incremental, don't forget, we are going to be evaluating the new machine based on the incremental basis, always. In any case of appraisal, that's what we do. So I think we can appraise, we can determine what's the incremental profit before depreciation and tax for those 10 years, okay? That can be a first working to get the incremental, profit before depreciation and tax. Year 1, year 2, year 3, year 4, year 5, 6, 7, 8, all the way to 9 and 10. Okay, so year 1 we have 350 million. That's for the new machine. Under the old machine, it was able to make 280. So therefore, the incremental profit is going to equal 70 million. Okay, year 2, 400 million. Okay, minus. So you can have them. These are in shillings of million. 400 minus 300. They give us 100 million. Year 3, 420. Minus 320 give us 100 million. Year 4, 410 minus 340 to give us 70. 5 is 410 minus 340 to give us 70. Year 6, 380 minus 320 last year we are 10 to 80 minus 240 to give us 40. Okay, that's of course is our first working, okay, to get the incremental profit before depreciation and tax.
Excuse me, sir.
Sure, Michael.
There's someone who is requesting that you admit him. He's been waiting for so long in the waiting room.
Oh, I've just admitted them. And let me try again.
It's okay. He has been admitted.
Okay. Oh. Sorry guys, my pen is misbehaving, so I'm not sure what will happen here. Anyway, so that's together for the incremental. This is 40 million, okay? Don't worry about here, I can't rub off here. So we get therefore that will be an incremental contribution, incremental profit before depreciation and tax for each of the year, okay? Next, don't forget, we are doing a replacement of the old machine with a new one. So you may want to tell therefore what's the incremental cost of capital, okay? What's the incremental cost, initial cost of investment, okay? That is a better term to use, okay? So therefore, we can say working two is the initial cost, okay? Definitely on incremental basis, the incremental cost. So cost here, we are going to purchase the old machine, the new machine. Oh yeah, the pen is now okay. So purchase of the new machine. So the new machine, we've been told that it has a cost of 8 million. Okay, they're not in millions, but they're in thousands, these figures here. Okay, because that can make a huge difference. Anyway, so you get to know that these are not in millions, but they're in thousands. Okay, so it is going to cost 8 million. So here, 8 million as the cost of the new machine. An additional cost of installation will be incurred. Therefore, next is installation cost. Installation cost of 400,000. Next, we do need to dispose of the old machine. The financial analyst of the company estimated that the existing machine could be sold for 2.5 million at the current prevailing market prices. Okay, so sales proceeds, you're going to be disposing of the old asset, and you get some money. So this is going to be a cash inflow equal to 2.5 million. Okay, these others are outflows. So let me put them in negatives, and this is a cash inflow. So therefore, it's a positive. Okay, is in working capital. The new machine is expected to increase the sales, whereby data will increase. So I think we can have here. Let me just have small working capital investment. The working capital investment the company must make. Okay, so first there'll be a data. The company need to invest towards data. And how much is they need to invest towards data? 320,000. Okay, then we have inventory. The company also need to invest towards an increase in the inventory investments. Okay, you'll be told the inventory investment is going to increase by 140 million. Then also to that payables will also increase. So payable, okay, this is you're going to be payable is going to increase. So it's a negative 320,000. 300,000. Sorry, not it's 300,000. So 300,000. Okay, and that is it. Okay, therefore, net working capital give us 320 to give us 160,000. Okay, so therefore, here we need to invest in a zero working capital cash outflow of 160,000 because you are investing, you are paying, okay, for inventory, for debtors, and less in the amount you'll be receiving from your suppliers to give us 160,000, okay, and that's therefore makes up the initial investment cost, which is how much?
$5.9 million.
We get 5.9 million, okay, is the initial investment that is required by the company as at year zero, okay. You're done with that. Next we can do, does this company give? Yes, as per note 2 and 3, there is tax, and note 3, there is depreciation. So therefore, next working can be on capital allowances. Tax saving because of capital allowances. Okay, tax savings. That is based on the tax depreciation.
Sorry, sir, to
Yes.
interrupt you.
Mm.
We need to subtract 5.9. We need to add. We need it. It's supposed to be 6.4. It's supposed to be 6.06. Sorry.
So 6.06.
Yes.
Hey, where are the others? They are not correcting you. They should. 6.06.
Yes, 6.06.
Yes, 6.06.
Okay, thank you. So 6.06 for the initial investment. Okay. And fair enough, we can now go to the tax depreciation. Don't get here the old machine and the new machine. So we need to evaluate what is the current, okay, what would be the current tax depreciation on the new machine, on the old machine. We compare that with the tax depreciation on the new machine, okay? So we can begin with the old machine. And the old machine, we told that it was bought 2 years ago at a cost of 4 million. Then its useful life was 5 years. Therefore, we can say then the depreciation per year, and by depreciation, I don't mean account depreciation, I mean tax depreciation per year, then was equal to the cost of the asset, which was 4 million. We divide by 5 years. Okay, so therefore every year the depreciation was equal to 800,000. It has already been used for 2 years. Okay, therefore you can say accumulated depreciation or already claimed depreciation, tax depreciation, okay, is equal to times 2, is equal to 2 years times 800,000. So therefore the company has already claimed allowance of 1.6 million. So therefore what is remaining is 2.4 million. Okay, therefore we can say therefore after evaluation, okay, after the evaluation, this asset can be used. However, the value has now estimated that the machine shall have an economic life of 10 more years. Okay, so going forward, it can still have 10 more years. Okay, therefore, you can say therefore, you're going to be claiming on what is remaining. Okay, which was 4 million minus what you have already claimed. You have claimed 1.6 million already. Okay, so this is what is remaining is going to be the NBV, actually the net book value. is what you'll be claiming going forward for the next 10 years. Okay. However, don't forget you're going to get something back in terms of disposal value, and you'll be told that at the end of 10th year, you can get back $500,000. So 500,000. Okay. We divide by 10 years. Therefore, if we had continued using the old machine, how much can you claim per year going forward? $190,000.
Yes, 190,000.
Okay, for going forward, every year you can claim 190,000. That's for the old machine. Okay, but don't forget we are going to dispose it. But anyway, let's now do the new machine. Okay, if the company goes ahead and purchases a new machine, okay, the amount they can claim is the cost of the asset, and the cost of the asset, let me just go back to a previous working, okay, is the sum of these two, the purchase cost and the cost of installation, which is given therefore 8.4 million. Okay, therefore that's what is on what you can claim allowances on the 8.4 million. Therefore, to be equal to 8.4 million minus the disposal value. At the end of the 10th year, can you claim something from this machine? The new machine has an equal life of 10 years. You're not be told anything about it. So here we make an assumption. We make an assumption that they to have a zero disposal value. So unless I'm not seeing, I can't see it. Unless maybe my eyes are not okay, I can't see it. Or even I can see the disposal value of the new machine.
There's none.
Okay, I think it's just zero. We divide by number of years, which in this case is equal to 10 years. Therefore, every year you can claim 840,000. Okay, this is the amount the company can claim, 840,000. But don't forget they have lost 190. Okay, therefore net capital allowance. Therefore, net capital allowance is equal to 840,000 minus what you have lost, 190,000, to give us a net of 650.
650. Yes.
Okay, to give us therefore net capital allowance of 650,000. Therefore, the implied tax saving, therefore the implied tax saving will be equal to 650,000 times the tax rate as per note 2, which is 30%. Therefore, how much do you claim per year? 185?
195,000.
195,000.
No, 195.
Yes, 195,000. You can claim 195,000 to be the allowance per, yes, the allowance per year. Okay, and that is it. You done the workings. Okay, that is it. So therefore, you can have here 1, here 2, 3, 4, 5. How many years? 7, 8, 9, all the way to 10. Okay. Year 1, because we are going to start with incremental profit before depreciation and tax, which you have already done. 100, 70. Yeah, 5. We have 70, 60, 70, 70. Okay, and 9, 40, 40. Then thousands, okay, then pay tax. And pay tax rate of 30%. Okay, so at that percent, 30,000, 21,000, 21. It's 21.
Excuse me. Year 1 was 70. Year
Yeah.
1 is 70.
70.
Yes.
70. Year 1 is 70. So did I confuse here? Let's see. This was 70. Year 2 is 100. Year 3, it's 100. Year 4 is 70. So this is 100. Okay. Year 4 is okay. Year 5, is it okay? Yeah, 70, 60. Year 5, 70, 60. Okay. 21, 21. This is 12. 12. However, we have tax savings, don't forget. Every year we have a tax saving equal to 195,000 from working above there. Okay, there's no scrap value for the new machine. However, we need to account for the scrap value for the old machine. Would you be told that in case the old machine was to continue to be used until the end of year 10, we could be able to fetch how much? We can be able to get 500,000, but you won't get 500,000 because you have already disposed of the asset in year 0. So therefore, that's an opportunity benefit lost. So therefore, negative 500,000. Okay, that's for the old machine. Okay, so it's a negative because you lost it. Okay, you're not going to be getting 500,000 because you have gotten 2.5 million today. Okay. Working capital, so there we're going to be recovering the working capital. The amount we did invest in year 0 is now going to be recovered in year 10. And you're going to get how much? You're going to be getting, we have done working somewhere, working capital, 160. So you're going to be getting 160,000 cash inflow in the final year. And that is it. Okay, so cash flow. Year 0, 1, 2, 3, 4, 5, 6, 7. It's a 9. Okay, cash flow. We discount back to year 0 the company cost of capital, which is 10%. Get the present value. All the way until last year. Cash flow times the factor, give us present value each of the year, okay, for the next 10 years. NPV will be the sum of present value from your calculation above minus the initial cost, which we have already done. Initial cost, we got 6.06, if I remember. Yes, initial cost we got to 6.06. And you get the NPV. And once you have the NPV, of course, we advise the company. Okay. Work it out.
44
Year one, what is the cash flow for year
on
one?
the cash flow. And
Year
then when I come to the PV,
No.
I'm getting to 44.
Year one, what do you have? Year one. Let's begin with year one. 244.
Yes,
Okay, so year one to 44. Year two,
I'm getting to 65.
65. Year three,
To 65.
year four,
To 44.
44. Year five,
Year 5 to 44.
year six,
To 34.
year seven,
244.
234.
No, year 7 244.
Year 7 244.
Yeah, year 8
Mm-hmm.
237.
237.
Yes.
Year 8?
Year 8 247.
And maybe there's a problem because year 7 and year 8, they seem to be the same, isn't it?
Yes, yes, yes.
Yes, so there are things there.
Sorry?
Year 8 is a problem because it's the same as year 7. So it should be 244 also.
Year 6
Year
is
6 is the one that is
237.
Okay, someone to, okay. Sorry, Cindy, what do you say?
Year 6 is 237.
Year 6 is 237.
Yes.
Okay, so here there's a problem, 237. Then year 8. $244 year 8.
Yes, 244.
244 year 9.
You have seen where the problem is.
Have you seen it?
Yeah, on year 6 and year 8.
Ah, okay. Year 9, let me just complete year 9. If someone wants to confirm the cash flow. What is year 9 cash flow?
223.
223. Year 10.
Negative 117.
Negative 117.
Yeah.
Okay. And then you discount back to year 0. Oh, don't forget these factors, you're going to obtain them from the tables. So simply the cash flow times the factor to give us the sum of present value, then we less the 6 million to get the NPV, and we give the advice. Okay. Any question? Okay, so I'm giving you a question. We can
Could you please scroll up? I take a screenshot.
There is okay.
Up again.
Where?
Above, yes, above the solution. Yes.
Until where?
There. Yes, until there. From initial cost.
Oh, initial cost. There is from initial cost. There you have
Okay.
it. Okay. So I've shared a question, which I guess we can do it together. This is from December 2010. December 2010, okay, 10 years ago. Okay, it's a question they're asking us to do the NPV, okay, which I think is a good question for us to close this chapter. So go through it, then we discuss together. Okay, I presuppose that you have gone through the question. Okay. So you've been asked to get the NPV. Number 2, you meant us to get the IRR, which we shall discuss right now after you're done the NPV bit. Okay. So this is December 2010, question 3B. So here you've been asked to get the NPV. Okay. So first of all, you've been told that we want to buy, this company want to buy a machine. So this is not a case of replacement, but this is a case of supplement. Okay, the new machine is coming in to produce those units. Okay, in collaboration with the old one. So it's not like the case we've been doing before, where we are replacing the old machine with a new one. No, this is a case where we have an old machine and the new machine is coming in, okay, to produce the extra demand, okay, where in code the old machine is not able to produce, the new machine comes in. For example, the old machine we told that can only produce 1 million, okay, and the new machine is coming in to produce extra. So maybe the first working therefore can be, what is this? How many units therefore is this new machine going to be producing? Okay, so incremental units. Okay. Actually, let me just call it incremental contribution. Okay, let me just call it incremental contribution. Because the first thing you need to get is to get the incremental units that the new machine will come in produce. Year 1, year 2, year 3, year 4. So the demand is 1.4 million. Don't forget 1 million is produced by the old machine, okay, which we are not analyzing. Okay, therefore, minus 1 million, therefore 0.4 million units. So the new machine will come in year 1 to produce 0.4 million units because 1 million units are produced by the old machine. Okay, year 2, 1.5 million minus 1 million to give us 0.5 million incremental units. Year 3, okay, 1.6 million minus 1 million to give us 0.6 million. Okay. Then year 7, we told is 1.7 million. However, don't forget, the new machine can produce a maximum of 600,000. I hope you're able to note that. Okay, the new machine can produce a maximum of 600,000. The old machine can produce a maximum of 1 million. Therefore, the two combined can produce a maximum of 1.6 million. So they can't go beyond that, even though the demand is still there, but they can't produce more than 1.6 million combined. Okay. That's the incremental units, okay, to be produced each of the year. Our concern was to get the contribution, the incremental contribution. So first we can get the contribution per unit. Which of course selling price minus variable cost. The selling price will be told is equal to 80. However, the company do incur a variable cost of 50 and other variable cost of 19. So the two combined, therefore, what remains after taking care of the total variable cost is equal to 11, isn't it? Yes, 11. So therefore, incremental contribution is the incremental units times 11 times 11 times 11 times 11. You get how much? Year 1?
4.4.
5.5.
4.4.
4.4 million. 5.5 million. 6.6 million. And 6.6 million. Correct me in case any of the figure is wrong. Okay. Those come for the incremental contribution to be received from that machine. Okay. What is remaining? And that is it for that particular working. Then to that, there will be a fixed cost that will be incurred, which is equal to 2.4 million in the first year. Therefore, year 1, we have a fixed cost of 1.4 million. This is going to be increasing by 200,000 per year until year 4. Okay. The company can claim allowances on a rate of 25% on a reduced imbalance basis. Okay. This will be our next working, therefore, can be on tax depreciation or capital allowances. Okay, so you'll be told that the cost of this machine is equal to how much? The cost of this machine is 8 million. Okay, 8 million. So therefore, now year 1, it's going to be used for 4 years. And in this case, in this time around, we are using reduced imbalance basis. Okay, which I think you are all expert in. Okay, so the cost of the machine, 8 million, times the rate of depreciation to give us 2 million to be the allowance for year 1. Balance brought forward 6 million, 25% to give us 1.5 million. Okay, balance brought forward 4.5 million times 25% to give us 1 million, 1.125 million. I'm not sure about the figure, confirm. Year 4 is the final year, so we claim balancing allowance. They're okay.
I have a question
Sure.
on the incremental. Like our year 4, I'm seeing it's 1.7 and we calculated with 1.6.
Yes, okay. Because we've told that what's the capacity of the old machine? What is the capacity of the old machine? How much can it produce?
That's the unit for the unit for demand for the old machine.
No. The old machine, how much can it produce? What's the maximum it can produce, the old machine?
600 units.
No, the old machine can produce 1 million. That's the old machine. The new machine can produce a maximum of 600. Therefore, the two combined, what is the maximum production? 1.6 million. Okay.
Okay, I think I'm not getting. Okay, you've said the old machine capacity. Okay, I've seen the maximum output of 600.
The first paragraph, just before the demands. First paragraph. Mavoko manufacturing, well, the current production capacity is 1 million. Can you see it?
Yes, I've seen that one.
Yeah, so the new machine is coming to produce the extra demand. And don't forget, the old machine produced 1 million, which means therefore in year 4, the two machines combined can only produce 1.6 million. Can you see that? So the demand will be there. However, you can't be able to satisfy the demand. So you have to let go a demand of 100,000.
Oh.
You can see it. The demand is there, but you can't satisfy that demand because you don't have the machine.
Oh, okay. Yes, so the demand is at 1.7, but we can't satisfy it.
Yeah, you can't produce. Yeah.
Yeah, I get it now. Thank you.
Okay. Okay, so going back to the tax depreciation, okay, are they okay? Year 1, year 3, year 2, year 1 to year 3?
Yes.
They're okay.
Okay, fair enough. So for year 4 is the final year. The final year, don't forget you claim the balancing allowance, okay? Don't forget by the end of year 4, the total amount you can claim is the cost of the asset, which is 8 million, minus anything that you get back, okay? So is there any salary value? Yes, 0.3 million. Therefore, the total amount you can claim, therefore, is 7.7 million. Therefore, what's the balance figure, which is our balance allowance?
$3.075
3 million
and 75,000.
and 75,000. Okay, those are the allowances that you'll be getting each year, okay, for the next 4 years. Don't forget our main concern is the tax savings out of those allowances. So therefore, you can have here tax saving. But don't forget the other method I told you, where you can less than add back, which I don't like. But in case you like it, you can use it. You don't need to do this working that follows, okay? The allowance for year 1, this tax saving is the allowance times the tax rate, which is 2 million times 30%. I get the tax percent, 30%, yes. Then we get 600,000. Okay, we get 450,000. Year 3, what do you get? 3. %30 of the allowance.
$338,000.
338,000. And the final year 4?
922,500.
92,500 count therefore the tax saving for each of the year. But don't forget these are the taxes on its own arrears. That means therefore tax for year 1 is paid in year 2, tax for year 4 is paid in year 5. Okay. Now there's a bit, if you check on the last paragraph, okay, that is a topic we have not discussed, okay, on how to get the cost of capital. Don't forget, cost of capital is the return the person who is going to be financing the project expect to get, okay. So we have not done that, so I'll just give you what ought to be the cost of capital, okay. So don't worry too much about the workings I'll do here, okay. The topic we have not discussed, but I think you can follow, okay. So we do that 80% or 80% of the money will come from equity shareholder. So 80% of the money will come from shareholder, okay. And they are asking for a return of 10%. So 80% times the return they want, 10%. Then the balance 20% will come from debt, okay, and the debt is expecting a return of 8.6. But don't forget the debt has a tax saving, which is equal to 30% of the interest you pay. Therefore, what is your cost is the 20% times 0.7. So don't worry about too much, okay, this, because the topic here already discussed, but I think it's quite easy to understand. So to get with the cost of capital, just repeat, 80% of the money came from equity shareholder, and they want a 10% return. The balance 20% come from debt holders, okay, debt capital, can be a loan. They want a return of 8%. However, don't forget, because interest is tax deductible, 30% is a saving. So your cost is 20%. So to get to the cost of capital,
Nine point two
9.2%. Someone confirm 9.2%.
It's correct.
Great, get 9%. So maybe to the nearest, okay, so that can use our tables, we can assume to be 9.9%, okay? So that we can use our table. Therefore, to the nearest, 9%, okay? Now, having done that, I think we are done with the workings, so we can just go straight to our final solution. Year 1, sure.
Please, can you explain for me what you've done there?
Yeah, that's what I don't want to do that, because the topic you are not discussed so far, okay? But anyway, let me just explain. But if you don't understand it, don't worry. We shall discuss it down in some few topics alone. But just repeat, okay? If we do that, the money, 80% of the money, that is 8 million, will come from equity shareholder. So 80%, okay, it is. They're going to be expecting a return of 10%. So 80% of 10%, okay? So in short, therefore, they're not going to give you 100% of the money, but they only give you 80%. Therefore, the cost that is attributable to the project is 80% of the 10%, okay? Then the balance 20% will come from debt holders, okay? The bank loan, for example. So they are going to be financing you to the balance 20%. What do they want? They want 8% return per year. However, since this is debt, the interest you pay is tax deductible. Okay, I hope you still remember that. You've done this in tax already. Okay, so the 30% of the interest you pay is a tax saving. So what is your cost? Is the balance, which is 20% here. Okay, so that's on the cost of capital. Okay, if you don't understand, don't worry. Okay, for now, don't worry too much. Okay, so next we have here incremental contribution. So we can have here contribution. Year 1 we get 4.4 million. So let me have them in thousands. Year 2, 550, 660, and 660. Then you pay tax. There's a fixed cost actually before you pay tax. We have a fixed cost And you know that year 1, you incur fixed cost of 2.4 million, so minus 2.4 million. Year 2, it is 2.6 million. 3, 2.8 million. Year 4, 3 million. Okay, so what remains is 2 million. This is 2.5. That is 6. Okay, that's
Year 2 is 2.9.
2.9. Okay, year 3, 3.8.
Yes.
Okay, fair enough. Year 4 is okay also. Okay, that's okay. Then you pay tax at 30%. You pay tax 30%, so that percent of 2 million to give us 600,000. However, you're paying tax in arrears, sorry. No, the tax is paid in arrears. So the tax for year 1 is paid in year 2, which is 600,000. The tax for year 2 is paid in year 3, that is 30% of 2.9 million to give us
870.
870. Then tax for year 3 is paid in year 4, which is equal to 30% of 3,800 to give us how much? 140?
114, yes. 1140. 1140.
And year 5, we pay tax for year 4, which is how much? $1080.
Red.
Sorry, how much?
1080.
1080. Okay. Then don't forget you have tax saving. Tax savings. Okay. These are tax based, so they're also in arrears. Okay. The saving for year 1, which was from our calculation, we got 600. Okay, the positive is a cash inflow because they're saving. Year 2, 450. Year 4, 338. Year 5, 993.
Sir,
Yes.
that 338, I rounded it off. So I don't know if it's okay with you. It's supposed to be 337.5.
Yeah, it's okay because even my figures are in thousands, so
Okay.
no, this is okay here.
Okay.
Okay, so you have tax saving. There's no working capital. We have scrap value. Scrap value, which occur in the final year upon the disposal of this machine. So it's in year 4. And if you sell off the machine, you get back 300,000. So cash inflow, 300,000. That is it. That is it. So cash flow. Okay, year 1, year 2, 3, 4, and 5. 2 million, 2.9 million. Okay, the others. We just come back to a 0 at 9%. Don't forget I've done the rounding off. Get to the nearest of percent so I can use the table. Year 1, year 2, year 3, year 4, year 5. Get the present value, NPV, sum of present value of cash flows. We less the initial cost. And the cost of the machine, the initial cost, will be to the cost of this machine is 8 million, so minus 8 million. Get the NPV, and of course we advise the company. On the internal rate of return. Okay. Therefore, our next appraisal method is the internal rate of return. The internal rate of return. IRR, okay, simply called the IRR. You know, IRR, it's simply it's a rate of return, okay, or the minimum rate of return that the project is going to yield to the owners of the project, okay, to the owners of the business, okay, the minimum rate of return that the project is going to be yielding on to the owners of the projects, okay. It's simple, that's how we define the IRR. Is a minimum rate of return that the project is going to be yielding, okay, to the owner of the business, okay. Now, when it comes to its quantification, because we would want to estimate, okay, know what is IRR therefore, okay. We are going to be, okay, let me first write down so that before we explain more. It is the minimum rate of return the project will yield over its lifetime. Okay, that's called the IRR. Okay, and generally we know that as IRR, okay, it is actually, you can also define it as another way you can define it. It is the discount rate. It is the discounting rate that equates the sum of present value of cash flow, the sum of present value of cash flows to the initial investment cost. Okay, what I mean by that is that at IRR, sum of present value of cash flow, is equal to initial cost. Okay, but in case we discount, okay, in case we were to discount the cash flows from the project to the IRR, then you're going to be, or the sum of that present value cash flow will be equal to the initial cost. For example, in our case here, in this question I've just done, we have seen that the initial cost is 8 million. Okay, so in case we discount the cash flows of the project, okay, and get the sum of present value to equal 8 million, the rate we have used there is therefore our IRR. Okay. Therefore, I want to ask you a question. What therefore would be the NPV if we discount, or if we are at IRR? If the cash flows of the project have been discounted at the IRR, what is the NPV? We say that IRR, the sum of present value of the cash flows, is equal to the initial investment cost. Therefore, at IRR, what is net present value, NPV?
Zero.
Of course, it is zero. Thank you. Of course, it's zero. Okay, therefore, we can say at IRR, okay, therefore, at IRR, NPV is equal to 0. Okay, at NPV, therefore, NPV is equal to 0 at IRR. Okay. Now we want to, now therefore, how do we appraise the project? Okay, we have obtained the IRR, but now how to make a decision, okay, as to how we're going to be appraising this investment, okay? Now we make a comparison, okay? We are saying that IRR is a rate of return, internal rate of return. We make a comparison. Whoever is financing you, okay, what is the minimum return they are expecting? Don't forget, cost of capital is a minimum rate of return that the provider of capital are expecting. For example, in this question, the one we just done, we saw that the cost of capital is 9.2%. Okay, that means therefore, whoever is going to give you money, equity shareholder and debt holder, want on the minimum 9.2%. Now IRR, okay, we say the minimum return the project is going to yield. So in case, for example, the minimum return the provider of capital want is 9.2%, and IRR is 8%. Would you invest in that project? If the IRR, this is just an example, is equal to 8%, okay, and we have the cost of capital remain as it is, 9.2%, would you invest in that project?
No.
Of course not, okay? That's a simple decision criteria. That if there are, let me just put it down, decision criteria, is that if the IRR is less than cost of capital, like that example I've given, where the provider of capital wants 9.2%, the IRR is 8%, then don't invest, okay? If the IRR is less than cost of capital, reject the project. Okay, if IRR is greater than cost of capital, if the minimum return the project can give you is 10%, and the minimum return that these investors want is 9%. So on the minimum basis, this project is giving you higher return than the 10%. It's giving you IRR, it's giving its minimum is greater, the minimum return is greater than the minimum cost of capital. So of course, accept therefore, okay, accept the project. Okay, and if IRR is equal to cost of capital, then of course we have what we call a point of indifference. Indifference point. Is that clear? Okay, if it's not clear, ask. Okay, don't forget, cost of capital is the minimum return the providers of capital want. They are going to give you money to invest in this project, but they do have a bare minimum. For example, the 9.2%. Then compare that with what is the bare minimum term this project is going to give. If it is going to give us 6%, then why would you want to invest? Okay, if it is going to give us a bare minimum of 14%, then it's a good investment. Because at any point in time, we are in quote sure we are going to be getting a return greater than what the provider of capital are requiring. Clear?
Clear.
Okay, great. Joseph.
Sir, what could be the meaning? What could be your meaning of a different point?
Indifference, you can either accept, you can either reject. Okay, based on financial outcome, it is in the quote neither here nor there. It is not going to improve your status. It is not going to decrease your status. So you remain where you are. So it's you to make a decision. You as the owner of the machine. But as for the decision, it is not. There's no clear-cut decision to be made here. Is that clear, Joseph? I don't know.
Clear.
Yeah, it's. I don't know what's simple example I can give where you are indifferent. It's like I don't know. Let's say you're going to buy an item for 100. Okay. Okay. No, that is going to not be the best because there'll be cost of capital. Assume there's a product that you're making or you're selling. Okay, you're a retailer, and there's the product that you are selling. Okay, you buy for 100, you sell for 100. Would you invest in it?
Investing doesn't make sense because I won't lose anything or gain anything.
Yeah, so you're in that's the same example of an indifference point. No, nothing you gain, you don't lose anything, you remain there. So yeah, you remain there. In short, you're indifferent. Okay.
Okay, thanks.
Okay, so let's run a very simple example. Actually, I think I have it in my slides, so let me see whether I can get it. a very simple example here which can help us out. Yeah, here it is. Get there, huh? IRR 16%. Okay, how did it come up? Okay, we see that. Don't forget, it said at IRR the NPV is equal to 0. Therefore, the sum of present value cash flow is equal to the initial investment cost. Here, the cash flow is only 1.16. So 1.16 million. It has been present value term. It is received in year 1. So discount back to year 0. R to the power of 1 because it is in year 1. That's its present value is equal to the initial cost, which is 1 million. Showed up in here. So allow me to. Okay. Okay, is equal to 1 million. Is equal to 1 million. Therefore, R is equal to 1.16 million divided by 1 million minus 1, and we get 16%. Simple, that's we get there. No, because things are not that easy. Okay, and neither are they going to be easy in reality. Because what if you have 2 cash flows, year 1 and year 2? You can't use this method. Okay, what if you have 3 cash flow? Okay, you can't use this method. Okay, it's going to be very complicated if you try to do algebra. Okay, so what do? Okay, we follow what we call a trial and error method. Okay, we follow what we call a trial and error method. For example, go through this example and get the NPV. Go through this example and get its NPV. Then from there, I take you through. Okay, so first get the NPV of this project. In the next 2 minutes, you can do that for sure. $21 million. Okay. Now, as I mentioned, since we have here a series of cash flows, it's not a single cash flow. Okay. So you have to use a trial and error method. The use of trial and error methods. We have discounted these cash flows at 10%, where we got an NPV of 21 million. We wanted an NPV equal to 0. Don't forget, we want to get the IRR. Okay. So what therefore would be the discount rate we can use that is going to give us an NPV equal to 0. Okay. So we to make a trial. Okay, the trial and error method. So I want to decrease the NPV from 21 to 0, isn't it? I want to decrease the NPV from 21 to 0. Therefore, what should I do with my discount rate? Should I increase the discount rate or decrease it? At 10%, we got positive 21 million. I want to decrease the NPV from 21 to something close to 0. Should I use a higher discount rate or a lower discount rate?
You should use a higher discount rate.
Yeah, thank you. We should use a higher discount rate. Okay, you should use therefore a higher discount rate. Okay, a trial. Let me discount the same cash flows, but now, for example, do you have 13% in your table? Let's see if they have it. If we have it, it's a trial. Okay, I'll just pick 13%. No, it's not there. 14%. Okay, so the same process, but now we discount the cash flows at 14%. Okay, you can try 15 if you like. Okay, but for our case here, for us to be consistent, let's use 14%. Same cash flows, we discount them at 14%, and we get the NPV. What's the NPV? At 14%. And sometimes people can be lazy, so they don't want to show the NPV was obtained at 14%, but you should. Okay, so here you have cash flow. You do it again. You know it's tiresome, but hey, you want to do the exam and pass. Okay, same process. Year 1. 120, 150, 165. So the cash flow. 120, 150, 100, and 165. Discount the back to 0 at 14%. Get the present value. It repeats the same process. Okay. Get the present value. Get the NPV. Which of course will be the sum minus initial investment cost, which is 400 million. What's the NPV? Negative 14 million.
Negative 14 million.
Okay, negative 14 million. Seems the same was obtained by Lillian. Okay. Yeah, okay. I presuppose that we can, that's with the NPV. And now our idea was to get an NPV equal to 0. So if you remember, we had 10% here where we got 21 million. Let me just use 21 million positive. Okay. Then we have discounted. This is 0, the NPV. Here we have negative 14. Okay, on the side where the cash flow we have used here, no, the discount rate we have used here is 14%. Okay. Now we need to decrease our NPV by 21 million all the way to 0. Okay, from 21 million all the way to 0 here. Okay. However, from our calculation here, we can see that 10%, the difference 10%, 14%, which is 4%. Okay, 4%, the difference that is equivalent to the difference between the NPV here and here. Okay, which is 21 million plus 14 million because it's minus minus. Okay, whether it is therefore equivalent to 35 million, isn't it? Yes. Is that clear? The difference at this point, okay, and this point in terms of percentages is 4%. In terms of the NPV is equal to that 5 million. Clear?
Yes.
Okay. Therefore, you can say that there are that 5 million shilling. Therefore, 1 shilling. Okay. Therefore, 1 shilling is equal to. Therefore, we can say 1 shilling is equal to 4% divided by that 5 million. Let me just improve my handwriting there so it can come clear. I've just divided, okay, both sides by that 5 million. Therefore, we can see that 1 shilling is equal to, okay, 4% divided by that 5 million. Okay, a very simple fraction here. Okay, we want to decrease our NPV from 21 million to 0, a decrease of 21 million. And we know that 1 shilling is equal to 4% divided by that 5 million. What about 21 million? It will be equal to 4% divided by that 5 million times 21 million. That's clear. Okay, this is 1%. This is 1 shilling. What about 21 million? You see multiply with 21 million. And what do you get?
$0.024 million.
It has to be in percent. In percent?
2.4.
2.4. So you get 2.4%. Okay. So you get 2.4%. Therefore, we need to increase our discount rate from 10% to 12.4. But this, we are saying this is equal to 2.4%. Okay. And therefore, our error is 12.4%. And that's how you get the error, which is equal to, okay, maybe to make it easy, is it will be equal to 10%, which you add here, plus, around 10% plus 4% divided by that 5 million times 21 million. This is what you have here already, plus the 10 million. You have added 10 million here to get 12.4%. Okay, is equal to 10% plus, how did we get the 4%? It was 14% minus 10%, okay, times 21 million. How do we get that 5 million? It was 21 million minus 14 million. I'm just trying to go back what we did, okay? So there's nothing new here. So this will be equal to 10% was our lower discount rate. So we can say, let me call 10% A. So A plus 14% to be our higher discount rate. Let me call it B, minus 10% is A. Then 21 million was NPV at the 10% as the lower discount rate. So NPV A divided by 21%. 21 million was the NPV at 10%. NPV A minus negative 14 million was NPV at 14%. Okay, NPV at B. Where, just to put it into word, A is equal to lower discount rate, lower discounting rate. B is equal to the higher discounting rate. What is NPV A is NPV at the higher discount rate. NPV B is equal to NPV at the lower, no, it was at the reverse. This is the lower, not the higher, because A is at the lower discount rate, and NPV B is NPV at the higher discount rate. And that's the IRR formula. Okay, so you don't need to remember this for sure. But you don't need to count the formula. As you can see, you can use that simple graphic above here to help you out. Okay, this graphic can help you out. Okay, so you don't need to count that formula. But of course, in case you do remember it, to make sure things a bit easier. Clear? Question? Okay, I presuppose that silence means that you understood and got it clearly. Now going back to the question, okay, the question part A we have done, part Roman 1 we have done together, NPV. Now part 2 you mean us to get the IRR, the internal rate of return. Okay, that is from the question that I gave you from the December 2010 question 3B. Okay, so I want us to redo Roman 2. Okay. Now we have done the first step. The first step, of course, is to get the NPV at A. Okay, the NPV at A, and we got, if you just refer back to the question, we got what? We got 979,000. Okay, we got 979,500 to be the NPV at 9%. Okay, so you've done that first step. Okay, so now we want to go to do the NPV at B. Okay, we can increase our NPV, increase our discount rate to 12%. 12%. Okay, it's a trial. Okay, you can use another rate. Okay, so the same process, but we now get NPV at 12%. So it's not a must use 12%. Okay, I'm just saying that just because it's on trial and error basis. You can use 10%, you can use 11%. Okay, the idea is that ensure that the two discount rates are not too far apart. Okay, the range is not far apart. Okay, you can't have 9%, then the next one you use 30%. No, you can't do that. Okay, you're going to have a very high error of estimation. Okay, so ensure that the two discount rates that you choose are close together. Okay. So the first one was 9% and we got 9.9. Okay, so just taken 12%, we get the NPV and the 12%. Okay, so same cash flows, don't forget. Okay, so cash flow year 1, year 2, year 3, year 4, and year 5. Yeah, okay. So present value interest factor at 12%, we get the present value. Okay, so year 1. Just refer back the question and don't forget again to replicate all those cash flows we got. Year 1, 2000, year 2, 2900. So 2000, 2900. Year 3 was how much? Because we never did it together. Year 3 cash flow?
3380.
3380. Year 4 cash flow?
3098.
3098. Year 5 negative?
Negative 157.
157. Okay, discount the back year 0, but now at 12%. So get the present value. Okay, we get NPV. NPV will be the sum of present value cash flows from above minus 8 million, the initial investment cost. What do you get to be the NPV?
Mm. 13.92.
13.92. Someone confirm?
$13.93.
Okay, 13.92, 13.93. Okay, I presuppose that that's therefore to be the IRR. Okay, of course, for us to make a decision as to whether we should invest or not invest the project, we compare with the cost of capital. Okay, which we got 19, which we got 9%, 9.2%, and you can see therefore the IRR is greater than the cost of capital. Therefore, invest the project. Okay, they advise the company should invest in the project or in the machine the project since the IRR 13.92 is greater than the cost of capital 9.2% or 9% in case you want to use 9%. Yeah, and that's how we appraise the project, okay, based on the IRR. Clear? Question?
Okay, on my end, I think I'm getting different answers,
You getting?
and I'm not sure where exactly I'm going wrong.
What are you getting?
On the before calculation, when calculating the sum of the cash flows,
At 12% or at 9%?
I don't know where I'm getting from.
At 12%.
At 12%.
Okay, so what's the present value for year one cash flow? Then others can critique. Year one present value.
Okay, I'm getting 1,786.
1786.
Yes.
Year two.
2312.
Year three.
3379.
Year four.
1969.
Year five.
Negative 89.
They're all correct.
Year 3.
Year 3, you didn't find the present
24.
value.
Year three.
Yeah.
So year three.
Year
3.
Okay.
2406.
So it is 2406. You didn't get the present value. That's what they say. Year three.
Oh, yeah. I've seen. Thank you.
Okay. And that's how we use the IRR method to appraise the project. Okay, so comparing the cost of capital versus the minimum return you'll be getting from the investment. So this is a good investment because the minimum is 13.92. The cost is 9%, 9.2% is a good investment. In quote, in the worst case scenario, we are in quote like assured. Okay, we can afford to pay off the 9.2% because the bare minimum return we'll be getting is at least 13.92%. It's an investment therefore the company therefore should invest, they should accept the project. Clear? Question? Okay, fair enough. Seems to be no question. That means that we all did understand and understand well. Okay, fair enough. Then we can end the class here. We meet on Wednesday. We do like 1 or 2 examples on IRR. As we clear off with investment or capital budgeting decision. Okay, then see you then on Wednesday. Enjoy your evening.